Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Cleef, and I am thrilled you're here. And you guys are going to love the guy we're interviewing today. His name's Buck Joffrey, and Buck has his own very successful podcast as well. It's called Wealth Formula. He owns 7 apartment buildings, a medical office building, and 500 plus units. He's actually a physician and, of course, an entrepreneur, asset manager. He is just a really nice guy. Buck, thanks for being on the show, buddy.
Thanks for having me.
Absolutely. So that bio and background was a little bit short. Can you tell us maybe a little bit about how you got started in real estate and why you love it? And,
you got it. There. Well, so I am a surgeon. I started out sort of as more of a traditional, high achieving A student type guy. And when I finished my training, I read, one of these purple books, right? Robert Kiyosaki's Cash Flow Quadrant. And it changed my life. And all of a sudden I started thinking about money. Well, and I never had to think about money because as a surgical resident, I was always broke anyway. So it's not like I ever had any money, but it was around 2008. And now you look around what's going on, and I'm looking in all these people who were in the stock market were getting killed, right? So there was all these really nice doctors that were older who were doing all what they were supposed to do. They were investing in stocks, bonds, and mutual funds for the long run, right? And guess what happened? They got reamed. Well, that happening, reading Kiyosaki's Cash Flow Quadrant, and then, quite honestly, looking at my dad, who is a real estate investor my whole life, and I didn't really pay attention to him because I had no interest in it at the time, and seeing that, 2008 treated him pretty well. All these things kind of changed my paradigm. And I think at that point, I started making money. And for the first time, I started thinking, well, how am I going to invest this? I'm not going to do it the way everybody else did it. And that sort of created this entire new world for me. And I kind of took off from there. I started buying apartment buildings. And I will tell you that I love real estate. I'm a real estate person, but I really do just consider myself generally an investor. I consider myself an opportunistic real asset investor. And so that's basically the story. So,
okay. If you don't mind, obviously my listeners are interested in multifamily. That's I have aspiring and experienced and very seasoned listeners. Tell us about a notable deal that you took down, maybe one that was challenging or, let's start with that.
Let me tell you about the first one.
Okay, perfect.
This one is right off the heels of me getting super excited after reading Kiyosaki and reading books from my friend Ken McElroy, who
Kenny's awesome. Yeah, we've had him on the show. He's awesome.
Yeah, Kenny's great. And ABC's a real estate, and I read the Advanced Guide to Real Estate, and I learned all about cap rates and net operating income and leverage and all these things. So of course, a little overconfidence, a little bit of knowledge is dangerous, as they say, right? So I go to LoopNet, right?
Of course, that's where everybody goes, right?
Right. It's otherwise known as the place where deals go to die.
Right.
Right. So I go to LoopNet and I search through filters. I saw a filter for cap rate. And I don't remember what I put in, but I just looked at the properties with the highest cap rates. It made sense. So I don't understand why people wouldn't do that.
Duh.
Sure enough, right? Deal in the suburbs of Chicago, southern suburbs of Chicago. And it looked great. I mean, the numbers were phenomenal, right? And of course, I go down there. It didn't look too bad. I mean, maybe it's a little rough neighborhood.
How many units?
It was something like 14 units, I want to say.
Okay. And keep going.
So the numbers look great, right? And I did everything I was supposed to do, plugged it in, looked, wow, this is great. I'm going to make 20% plus cash on cash. I can't even believe this thing's sitting there available. So I buy it. And of course, it's sort of the rookie thing, right? I mean, I bought a property before understanding how it was going to be managed. I bought a property, before looking at really the demographic. And this happened to be a D-class building.
Sure, and south side of Chicago. There's some tough areas there.
Right,
what I've heard.
This wasn't like a dangerous area. It was just, it probably was a little dangerous. I just was too dumb to even realize that. But there wasn't anybody who could manage it well. And I wasn't going to go manage it myself.
Right.
So anyway, long story short, the issue, there was a couple issues here. It was managed by a landlord who had a few buildings in the area. I think there's reason to believe that he actually was shifting some of the rental income to this building, even though no one actually.
Oh, to build it up. Build it up. Okay.
Right. Because for whatever reason, he was not having success with this building, and that's why he was selling it. We figured that out because there was people in the building. The manager that I had said there's people in the building who were told that they were just going to move to this other building for a while. They didn't have to pay rent. Anyway, the issue there obviously could become a big legal one, but when you're dealing with a property that, that size and that level, I mean, the legal bills alone would probably
dwarf the purchase price. So how long ago was this?
That was in 2000. I want to say probably 2010.
Okay.
2010.
Good time to be buying for sure.
Yeah, right. Kind of missed the boat. Maybe it was 2009. I don't know.
Wow, that's even a better time to be buying. Okay.
Yeah.
How did it end up? What was the finish line like? I mean, you still own it, or is it?
No. I sold it. Lost $300,000.
Oh, ouch. Okay. Wow.
I lost more than that, honestly, because I was negative cash flow for so many months.
No kidding. Okay, so that was a massive seminar. Okay, so what would you have done differently?
Well, first, there's lots of things I would have done differently. First of all, I'd say I don't do D-class buildings anymore at all. Right?
No.
I think it's not a good idea. I mean, I think there's people out there who do well with this stuff, but it's not me.
I have in the past, and I will tell you, guys listening, please don't start there. Please. Here's a great example of why not. I mean, I've had holes cut in doors where houses turned into crack houses and streets blocked off just to slow down the drug traffic. And no, you don't want that. You don't want that pain.
Yeah. And don't let the numbers seduce you. I think that's a big rookie mistake. I mean, that was the biggest rookie mistake, because you think you're super smart because you know how to read these numbers and you're putting in cap rates and NOI and all this stuff. And then you just don't think of the big picture.
What could you have done that would have flagged this for you differently? Let's add some values so that my listeners don't make the same mistakes.
So first thing is, I won't buy a property unless I know who's going to manage it.
Good one. Yeah.
Right. That's critically important. You've got to figure out, before you have a property, you got to have a team. It doesn't go the other way around.
Okay.
That's really, really important. Property manager, who's going to manage it? What's their track record? And you want to interview property managers before you buy that property. The other thing is, I mean, in this case, of course, I said no D-class properties, but there are some things that I could have done. And again, I've never been in a position to need to do this anymore, but, I had a rent roll and I didn't know that I necessarily needed to verify that everybody lived there.
Right. Yeah, there is that little wrinkle. Yeah. And so there's a big difference between the rent roll and economic occupancy.
Right.
And is there anything you could have done maybe when you went to visit the property differently? What might you have done, or even before you went to visit? Is there anything that might have flagged things for you?
Well, I think there's so many tools these days that I could have used, right? I mean, I could have looked at the surroundings. I could have looked at the crime.
Spotcrime.com.
I could have looked at the demographics. I could have done all, I could do a lot of these things. And,
things that you didn't do that now and okay.
Absolutely.
Yeah. So, you can go on Google Earth, you can drive down the street, you can look at the cars in the parking lots, you can get a real read on, the type of people that live there. Of course,
probably another thing that I think is actually a useful thing to do. We'll do this for 100, 200 unit buildings now, is drive by there at night.
Of course. Yeah. 10 o'clock on a Friday night. How does it, how does it feel?
A bunch of people hanging out up to no good. That's a bad sign, right?
Right. Absolutely.
So there's, I can't even tell you how many things I could have done, but.
Well, that's kind of where I wanted this to go, because there are people that see these deals and they see these 15% cap rates or 12% cap rates, and they're like all excited. And do the homework, guys, to check the demographics. Go on bestplaces.net, census.gov, citydata.com. See if the population, the income, and the jobs are growing. Go on Google Earth, see what the area looks like. If you drive down the street view and you drive down to the main road and there's a pawn shop and a liquor store and a strip club, that's a clue. Okay, well, that's really where I wanted to go with this. And just don't be seduced, guys. That's the point here. And I would not be a new investor and go to D. I just don't do it. That's my advice to you, and I hope you listen. So tell us about a victory. Tell us about a win. Tell us about a property you bought that just turned into a home run.
Well, I got a little gun shy for a bit.
Yeah, 300 grand hit is a big hit.
Yeah. I wanted to make sure that instead of going in on something that I talked to people who owned a lot more property before I did it the next time. So I got kind of lucky. And what I've realized over time is that the deals that I buy now are typically off market. They're things that are not retail deals.
How do you find those off market deals? So is it broker relationships? Is it your own marketing efforts? Speak to that for a moment.
It's been relationships, and it has been more than brokers for me. It's more than real estate brokers. It's actually been mortgage brokers.
Oh, isn't that's there's a clue, guys. That's a good one.
In particular, I have a guy who, again, a lot of it's sort of, you're in the business long enough and you make connections. And I call this tribal investing, right? Is like,
I like it.
Yeah. I mean, I call it tribal investing because now I only invest in things when the cards are heavily stacked in my favor. That takes a while. You have to be around the stuff to get those connections.
Sure.
And so now I only buy property when I've got an advantage. And so the next couple properties I bought, let me just tell you about those.
Yeah.
Were, I think in 2010, 2011, they were from the same friend of mine who I actually invested in his hedge fund.
Oh, no kidding.
Yeah.
Okay.
And he and I became friends. He happened to do a lot of hard money lending too. And he knew a lot of real estate investors who were also investing in his fund. And so he started connecting some of us. And he had one guy who, for whatever reason, had wrapped in several $1 million of property into one loan. I mean, I don't know why he did that.
Right.
But he wasn't in a position where, like, the property was not the problem. He had some other underlying issues. He just needed to get out of this debt and unwrap these loans. So I ended up getting 2 properties from that alone.
From that package.
Yeah.
You selected 2 of the properties and you pulled them out and bought them. Okay.
Yeah. I mean, I bought 2 of the properties.
Because of that relationship through the hedge fund to, so guys, there's another clue. This is so relationship driven. And you've heard me say, don't be the guy that looks to get everybody's business card and meet everybody. Make them deep, meaningful relationships. Would you agree?
Yeah.
Buck?
In fact, understand that, and this is not, I mean, listen, there's a parallels to this in everybody's world. In this case, I had invested several $100,000 in this guy's fund.
Oh, okay.
He liked me, right? And in this business, like any other business, when you do something for somebody else, they're more likely to do something for you.
I just literally said that very same thing on Facebook Live 30 minutes ago. In relationship to mentors is a different example, but seek to help them. You give before you expect to get. And the same thing applies. This is what you're saying here, basically, right?
Yeah. I mean, this is life.
Yeah. Right.
And again, it's not saying be calculating. The idea is if you always go out there with people in business and in life in general, and the first thing you say is, how can I help you? And really mean it. You're much more likely to find something come back your way than you are if you come out there and say, what can you do for me?
That's the way to live. That is the way to live. And that is extremely sound advice. So you bought a couple of those buildings.
Yeah. So I bought these buildings. What was cool about them is they were not distressed at all. I mean, these were.
Where are they located?
In Chicago, there was 2 neighborhoods. There's one called Pilsen and one called Bronzeville. And they were both up and coming neighborhoods, which was really interesting too, because at the time, and again, this was probably, 2011.
Are you in California at this time, by the way?
Oh, yeah, no. I lived in Chicago.
You lived in Chicago. Okay.
Yeah.
Okay.
Right. I mean, pretty much, that's where I started out. I did everything.
Okay.
Local.
Okay.
Yeah.
So you did. Okay. That's great. That's obviously the best way to do it if you can.
Right.
For some reason, I thought you were on the West Coast. And
well, I'm sort of retired now, right? I mean, I don't practice anymore or anything like that. So I live in Santa Barbara.
Oh, God, one of my favorite cities in the
Yeah.
world. Love Santa Barbara. Okay.
Yeah, that's why I live here.
Yeah, it's fantastic.
Yeah.
I mean, truly, my wife and I drove through there, and really, that we both said to ourselves, we'd never done that before, that we could totally live there.
Yeah.
Okay. Well, anyway, so you lived in Chicago, so you were investing in your backyard at the time. Got it.
Yeah.
Okay.
So, I bought these buildings probably, the cap rate in the markets there were probably about 8.5. And I was buying these things at 10s.
Oh,
right?
wow. Beautiful.
And they were cash flowing like crazy. Now, here's the beauty of it. Not that it matters, but the cap rate's compressed.
Of course that matters, because then the values go up. You know?
Well, it matters if you're going to sell.
Right. Yeah, no, you're right. If they're long-term holds, it doesn't matter. You're
yeah.
right. Okay.
And so from a net worth standpoint, sure it does. And both of those buildings ended up doubling in price.
Nice.
I mean, easily doubling in price over the course of, literally, right now I could easily, pull off $1 million from each one of those deals.
Nice.
No problem.
Nice.
So
how do you handle the management now? Speak to that a little bit. Unless you were going somewhere else with it. I don't.
No.
Okay.
Listen, I'm not a property manager. I'm not a landlord. That's one thing that, watching my dad growing up, I clearly did not want to be a landlord. And that's why I became a physician, because I'm like, I do not want to do what this guy does.
Mm.
But you still got to manage the manager, right? You still got to walk the property a couple times a year. You got to figure out what the comps are in the area.
How large are those properties, by the way, just to give me some idea here?
Those particular properties, 20, 30 units each.
Okay. So they don't have the infrastructure to have on-site management. You may have one person in each place, getting a deal on rent and keeping an eye on things, I would guess would probably
No. But, I have the same management company for both. So it's like, combined probably about 50 units. And when you're in a market, over time, you get to understand who the reputable property management companies are and that sort of thing. So, and I had a referral on a good property management company. Again, that's the way I operate. I operate on referrals for the most part. When I buy,
that's the best way. That is absolutely the best way. No question.
Yeah. That's how it gets managed. Listen, I think you have to pay attention to what's being done. I think it's very difficult to get the most for your money if you're completely hands off. You have to at least be understanding what the rents in the area are, what your rents are. Are they appropriate? Don't be super happy if you've got 100% occupancy all the time.
That means your rents are down. Yeah, rents are too low.
That's generally not a good sign. You want to be, I like 90% occupancy. That's what I like. I think it's a good mix. So I think that's the big thing. Right now, I've thought about selling those properties. I think I could easily make a decent chunk of change in those, but I just don't. It's sort of like you. What's the idea behind investing in the first place? I mean, you want cash flow. Right? So I haven't really thought about doing that. And the other thing is, it's not like there's a whole lot on the market right now.
Yeah, to reinvest, right?
That you can reinvest, do a 1031 exchange. You're just going to end up paying a bunch of taxes. So
right. And I'm a big proponent for self-management, just so you know, Buck. But so when I have calls with people, I do strategy calls sometimes, and I say, so how are you going to handle the management? They always say, well, I know you want to self-manage. Well, I want to clear that up right now publicly for you guys. I do not believe in self-management unless you understand the business, number one, and number two, until you have enough of an infrastructure to justify bringing somebody in to do it for you. I'm not saying do it yourself. And so let me clear that up, because I get that all the time when I get someone on the phone. Now, I will say this. Once, in my opinion, if you're paying a management company to manage your managers, and you're paying enough that you could actually hire someone to do that and have the control yourself, I'm a big proponent for doing it yourself. That's me. Now, when you're in acquisition mode, absolutely not. Your focus should be on finding deals, putting deals together, financing them, pulling in partners, syndicating, all that business. You shouldn't be dealing with toilets. But like I said, I believe that once you do have that infrastructure, it's silly to pay someone else when you can have a higher measure of control for the same or less money with your own staff member. But
I think it depends where you are in your real estate career a lot. I have businesses and other
Same
assets.
Here. Yeah.
And so really the way I look at real estate now is the way I look at any of my businesses, right? All of my businesses have really good management in place. That's why I can live in Santa Barbara and my businesses are in Chicago, because I have good management in place, right?
Yep.
So, but that's another level. I mean, that's not.
Well, it takes time, and it takes time
right.
to get there. I've same here. I've got some fairly large business, 40 employees, $8 million company that, because I have high level management, I don't have to deal with the day to day in that business. It's just an aside. I don't even really talk about it on the show here, but you're absolutely right. And you can get to that point, and you can get to that point in your real estate investing career as well. No question. You can ultimately have a team to run your operation and play a more limited role. And that's the ultimate dream, if you ask me, is to put a team together. That's a great segue. Tell us about your team. Is it just you, or are you still actively acquiring? Are you, have you put a team together to do that? Well,
it depends. I mean, it's like certainly a team in Chicago and to manage the properties there. And also the way my team in general works is that I have a few different businesses, I have real estate, et cetera. And there tends to be a lot of overlap in management. I have one COO who really is just me on the ground, right? Like everything that requires operations, she is a machine.
Oh, right? That's awesome. That's awesome.
She's a machine. And so she really takes care of a lot of that stuff. On top of that, though, with real estate, I look at everything as I'm the CEO. I'm the CEO of everything. And so I have to have managers, and it doesn't mean I don't manage the managers. So most of what I do is manage the managers.
Right.
Now, I am in acquisition mode. It's been, as you know, it's been tough.
Sure.
I'm not interested in buying in Chicago anymore either, because one of the things that, we didn't talk about is learning a little bit about making sure that you understand, tenant landlord laws in a given place too. And they're not real favorable in Chicago. And that's something that I ended up kind of getting more interested in some other places like Texas and that. In Texas, my primary interest is in Dallas, Fort Worth. The issue is I keep getting outbid. And I think that the challenge is that, I have an on the ground, boots on the ground partner who's a multifamily broker in Dallas. And he literally, he is walking these things, literally going into apartment buildings and pretending to be a guy who's looking for an apartment. That's how granular we get on these things, right? To make sure our comps are right. He's got property and connections there, obviously, that we leverage as well in terms of property management, et cetera. But it's right now, I'd like to say I'm in acquisition mode, because we're certainly we probably sent out 10 offers in the last 3 months, and we've gotten outbid. We've been in the best and final probably 4 times now. And just, there's a lot of money coming from China.
Right. Right. So. And there's a lot of stupid money too. I'll be candid.
That's exactly what it is.
Yeah.
And I don't know if it's stupid or smart, frankly, because I think they look at real estate differently than we do. If you're a big pension fund,
well, they have no cost of funds. So, you can pay whatever, right? The return isn't as big a deal.
Yeah.
So they don't have to pay to get the money. There's no debt. There's, no, you can't compete with them.
Some of the foreign money is even worse, because,
right.
they don't care about cash flow at all. All they're trying to do is, like, Chinese groups and stuff like that. They're just trying to get
their money out
of China.
Right.
And then they buy a big asset, a $15-20 million asset. And then they just let it sit there like a piece, like gold, right? They look at it as gold. They look at it as an asset that, as long as it pays for itself, they don't care. They don't care about cash flow. They might even go negative cash flow. So.
Yeah. So let me ask you this. What's your read? I know you're connected with the same people I am, and probably even more connected with some of the people like in Kiyosaki's camp.
Yeah.
And what's your read on the upcoming contraction? What are your thoughts on that? I'd just love to get your opinion.
Well, I think it's just a matter of time. I talked to Ken McElroy about this last week, actually, and Kenny was, I was like, have you seen a market like this? And he's like, I haven't quite seen a market like this. And for those of you who don't know, Ken McElroy is the Rich Dad Advisor.
Yeah, he's been on my show. He's one of them, and I know he's been on your show. And he's a very, very successful multifamily investor.
Yeah, he's got
a super nice guy.
Great guy. Got $1 billion under management.
Right.
I'm an investor of his too.
Oh, no kidding. Okay.
So anyway, Kenny was talking about this, and because I look at this, listen, I've only been really in real estate. I've only had money since like 2009, right? So I haven't really seen cycles over cycles, and so I asked him, I was like, are you shocked by this? And he's like, I'm not really shocked. I mean, I think he's like, it is worse than probably I've ever seen. And that probably reflects the fact that we've never seen interest rates like we've seen them.
Right.
Right.
Yeah. I remember when 7% was a fantastic rate. I mean, you're doing backflips all the way to the closing table.
And people forget sometimes that cap rates are very much affected by interest rates. And that's why it's worse than it is. But cycles are cycles, and they happen. And he said, you know what, 2008, I just mentioned the Chinese, right? And it's the Chinese now, right? In 2017, in the late 90s, it was the Japanese.
Right. Oh yeah. So, I remember. Yeah. I remember going to Hawaii in the 90s, and they just bought a hotel for $1 billion. Couldn't believe it. Yeah. Anyway.
Now they have, of course, been in a recession for 20 years.
Right. Yeah, exactly.
Right. But the point of it was, and Kenny, all those guys, and I think myself too, although I'm probably less of a pessimist than most of those guys, is they see blood in the streets coming. And that's what they do.
Oh yeah. They've been touting that. They've been going around the world talking about that. And it's going to happen. And it's going to be an incredible opportunity. I tell my students that are complaining that they can't find a deal right now, and I say, I don't care. Line up your connections, learn the business, understand it inside out, backwards and forwards, evaluate deals, create the relationships, and when this market turns, watch out. You'll be perfectly poised to capitalize. And those of you listening, don't get frustrated. Keep hunting, keep looking. There are deals. I mean, they're much harder to find, but they're out there. But don't get frustrated, because opportunity, the real exponential opportunities are coming. They're going to come. And
and that's a really good point, Rod, because I think the challenge is, and I'm seeing this all around now, I'm fortunate. I don't need the money, right? I don't need it. I'd like more. I mean, who doesn't want more money, right? But on the other hand, I don't need it. And so I'm not desperate. And one thing to be very careful about right now as an investor, even if you're investing passively, et cetera, is there are a lot of people who've got deals out there and they want you to invest, and they're not good deals. Remember, you can make anything look good on paper.
Absolutely. You absolutely can. But a lot of times those pro formas are toilet paper.
Yeah,
exactly. Talk about paper.
So I would just caution everybody on that and just say, listen, just stick to principles. Mm-hmm. The markets always turn. And you know what? Every time at the top of the cycle, even if you look, look at the stock market, right? I mean, it's not, I'm not a Wall Street guy, but if you look at every 10 years, 1987, and then late 90s, and then 2008, it's like every 10 years, massive correction. And every time at the top, do you think the people who lost all that money thought they were going to lose money? No, they didn't.
Of course not. Of course not. No, I'm really glad we went there, because it's a time to have both eyes wide open, and it's a time to stick to fundamentals. It's a time to really do your exhaustive due diligence and be very careful on your market rent comparable analysis, because, in a 25 unit property, if you have a $40 mistake right now per unit mistake, like let's say you do a comparable analysis and your unit has washer dryer hookups and the one you compare it to doesn't, and you make a $40 a month mistake, it's in a 25 unit, that's a $600,000 value difference. And so, it's a big deal.
Those mistakes that people are making are exactly the deals that are going to be available.
Right. You bet they are. They'll be bank owned and they'll be back on the market.
Right.
They're going to be great opportunities. So don't get frustrated, guys. Learn this business, study it, immerse yourself in it, associate pleasure with it, and you will be perfectly poised to exponentially capitalize when it's at the bottom. So, sometimes I ask my guests this, and I want to ask you, what's your driver, buddy? What makes you jump out of bed in the morning? I mean, what motivates you?
That's a great question. I mean, as I mentioned, I stopped practicing medicine.
Right.
It's because I wasn't really enjoying it anymore.
Which is astounding after all that work to get there.
I finished my residency at 34, wow. Practiced for about 8 years.
Wow.
And, but I think the thing that gets me, okay, so let's back up, because I think this is a great topic, because what I've realized is that the most successful people I know, and I'm not just talking about the wealthiest people,
right,
but
success
the people
comes
who
in
are
lots of different ways, right,
wealthy and happy, are people who are driven by mission, have some kind of mission, right? You call it mission, you could call it self-actualization, whatever you want to call it. But if you get to that point, that's what gets you going. And for me right now, that's where I'm at. So I started my podcast and I started talking to people and stuff like this. This is what I really enjoy doing.
Yeah, same here.
I feel like I'm helping people, and I'm helping slightly different people than my listeners, because I happen to be a surgeon by training. I have a lot of healthcare professionals and people who make more money, right? But there are also people who need help and they haven't had a voice. So it's really nice for me to be able to go out and provide some service to others in that context. So what gets me going is constantly learning and constantly teaching, what I've had the opportunity and the fortune to be able to do because of the circumstances that I'm in. So
yeah, no, we're very aligned in that regard, and I get the same pleasure. So I'm really glad to hear that. And by the way, guys, before I forget, if you have not signed up for our multifamily group on Facebook, go to multifamilycommunity.com. There's already almost 1,600 people on there after like 2 weeks. So you definitely want to go there. Great place to learn and connect with people in your area. And I keep forgetting to mention it on the show. So multifamilycommunity.com. Go there. And in fact, a lot of my podcast guests are there to add value. So Buck, that could be a resource for you if you're interested. But anyway, check that out. Buck, thank you so much for being on the show, buddy. It's been a real pleasure, and you are a wealth of knowledge, and we're going to have to circle back and probably do this again at some point, because we didn't even really talk about mindset and some of the things that we enjoyed on your show.
Yeah. Anytime, man.
Yeah. No, thank you, buddy. So we'll stay in touch and talk again very soon.
All right. You take care.
All right. You too. See you later.
Thank you for listening to the Lifetime Cash Flow Through Real Estate Investing podcast. If you've enjoyed the show, please subscribe and then take a moment to visit iTunes and leave a 5-star rating and review. For more resources to connect with us further, please visit our website at lifetimecashflowpodcast.com. Tune in next week for our next show.